Banking negotiable instruments. Question and answers. These are all questions from old question papers. Short and long made into short. Collecting banker. A collecting banker is a bank that acts as an agent for its customers in collecting and processing payments on their behalf. When a customer of a bank receives a check or other negotiable instrument, they can deposit it into their bank account for collection. The bank then acts as the collecting banker and processes the payment on behalf of the customer. The duties of the collecting banker include presenting the instrument for payment. The collecting banker must present the check or other negotiable instrument to the bank on which it is drawn for payment. Endorsement of the instrument. The collecting banker must endorse the instrument in favor of the customer to whom the payment is due. Collection of proceeds. Once the instrument is paid, the collecting banker must collect the proceeds on behalf of the customer and credit the amount to their account. Notification of dishonor. If the instrument is not paid due to insufficient funds or other reasons, the collecting banker must notify the customer of the dishonor of the instrument. Safekeeping of the instrument. The collecting banker must take reasonable care in handling and safekeeping the instrument until it is presented for payment. The collecting banker is also responsible for complying with the relevant laws and regulations related to collection of negotiable instruments, such as Negotiable Instrument Act and Reserve Bank of India guidelines. It is important for customers to choose a reputable and reliable collecting banker to ensure that their payments are processed in a timely and efficient manner. Second point, banker's lien. A banker's lien is the right of a bank to retain the property of a customer in its possession as security for an outstanding debt or obligation. The lien can be exercised by the bank over any property, assets, or funds held by the bank for the customer, including deposits, securities, or other financial instruments. The banker's lien is a legal right that allows the bank to hold on to the customer's property until the customer satisfies the outstanding obligation or debt owed to the bank. This lien can be exercised even if the customer has given instructions to the bank to release the property or funds. The banker's lien is not an absolute right. There are limitations to the exercise of this right. For example, a bank cannot retain property that is not related to the debt owed by the customer, and the bank cannot retain property that is not related to the bank cannot exercise its lien if it has already agreed to release the property or funds. The bank also has a duty to exercise the lien in a reasonable and fair manner and cannot hold on to property indefinitely. The banker's lien is an important tool for banks to protect their interest and ensure that they are paid for services rendered or loans provided to the customers. However, it is also important for customers to understand their rights and obligations regarding the banker's lien and to ensure that they meet their financial obligations in a timely and responsible manner to avoid the exercise of this right by the bank. There is a specific lien and a general lien. Specific lien is linked to the same person, same capacity, the same amount or same capacity, the funds. And general lien is if you take a loan on one item and then other deposits and other properties are held on to it by the banker. That is general lien. So specific lien, same to same, and general lien in one to many. The lien exercised over many. Bank guarantee. A bank guarantee is a financial instrument issued by a bank on behalf of a customer that guarantees payment to a third-party beneficiary in case the customer fails to fulfill their contractual obligations. A bank guarantee is a type of letter of credit, which is a guarantee of payment made by a bank on behalf of the customer. A bank guarantee is often used in business transactions, particularly in international trade, to assure the seller or a supplier that they will receive payment if the buyer fails to fulfill their obligations under a contract. The bank guarantee can be used to cover payment for goods or services as well as to secure payment for a performance bond or other financial obligation. The bank guarantee is typically issued for a specific amount of money and for a specified period of time. The beneficiary of the bank guarantee can make a claim against the bank if the customer fails to fulfill their contractual obligations. The bank will then pay the beneficiary the amount specified in the guarantee. There are different types of bank guarantees like performance guarantee, payment guarantee, bid bonds, advance payment guarantee, retention money guarantee. The terms and conditions of the bank guarantee will vary depending upon the specific transaction and the agreement between the parties involved. So, bank guarantees are financial guarantees and performance guarantees, mainly two. In summary, a bank guarantee is a financial instrument that provides security and assurance to a beneficiary in a business transaction. It is a valuable tool for managing risk and ensuring the contractual obligations are met. A letter of credit. Letter of credit is a financial instrument issued by a bank on behalf of a customer known as the applicant and must guarantee the payment to a third party beneficiary known as the beneficiary for goods or services provided, as long as the beneficiary meets the terms and conditions specified in the letter of credit. The term letter of credit has to be followed literally, word by word. The letter of credit acts as a binding agreement between the applicant and the beneficiary and the issuing bank. Applicant agrees to pay the issuing bank for the amount specified in the letter of credit, and the issuing bank agrees to pay the beneficiary if the terms and conditions of the letter of credit are met. The beneficiary can be a seller of goods or services or a supplier of materials or equipment. The letter of credit contains specific instructions and requirements that the beneficiary must meet to receive payment. These instructions may include providing certain documents such as bill of lading or certificates of origin or meeting specific delivery or quality requirements. The letter of credit may also specify a deadline by which the beneficiary must present the required documents to receive payment. The letter of credit can either be revocable or irrevocable. A revocable letter of credit can be cancelled or modified by the issuing bank without the consent of the beneficiary. An irrevocable letter of credit cannot be cancelled or modified without the consent of all the parties involved. Letter of credit is a valuable tool for managing risk and facilitating international trade. It provides security and assurance to the beneficiary that they will be paid for their goods or services supplied, while also protecting the applicant from the use of non-payment or fraud. However, it is important to carefully review and understand the terms and conditions of the letter of credit to ensure that all parties involved are aware of their rights and liabilities. Check. A check is a written document that directs a bank or a financial institution to pay a specific amount of money from the account of the person who wrote the check, known as the drawer, to the person or organization named on the check, known as the payee. To write a check, the drawer typically fills in the name of the payee, the amount of money to be paid, and signs the check. The drawer must have sufficient funds in their bank account to cover the amount of the check. Once the check is presented to the bank will verify the signature and availability of funds before making payment to the payee. Checks are commonly used as a form of payment in business transactions and for personal expenses, such as rents or utility bills. They are also used for direct deposits, where the payee can deposit the check into their own bank account. Checks can be issued as either a bearer check or a crosser check. A bearer check is payable to the person who presents the check to the bank for payment, while a crosser check is only payable to the payees named in the check. There are different types of checks, such as post-dated checks, which are checks with a future date for payment, and a stale check, which are checks that have not been presented for payment within the certain period of time and may no longer be valid within the validity period, nowadays 90 days. In summary, a check is a written document used for payment directing a bank or a financial institution to pay a specific amount of money from the drawer's account to the payee named in the check. Checks are common and convenient form of payment in business and personal transactions. Crossing of a check. Crossing of a check refers to the act of drawing two parallel lines across the face of a check. It's a means of adding extra security to the check by making it more difficult to be fraudulently misused. A crossed check can only be paid into a bank account rather than being cashed over the counter. The crossing on the check signifies that the drawer intends the money to go directly to the account of the payee rather than being withdrawn as cash. There are two types of crossing. One, general crossing. This is what the check is crossed with two parallel lines, and the words "and co" and "not negotiable" may also be added between the lines. A general crossing means that the check can only be deposited into a bank account, but it does not restrict the payee from endorsing the check to a third party. Special crossing. This is where the check is crossed when two parallel lines and the name of a bank is written between the lines. A special crossing restricts the payee from endorsing the check to a third party, as it can only be deposited into an account with the specified bank. Crossing a check provides additional protection against fraud and unauthorized use. It ensures that the check is only deposited into the account of the named payee or a third party specified by the payee and prevents it from being cashed over the counter. This helps to prevent check fraud and increases the security of the banking system. Protection to paying banker. In the context of banking, a paying banker refers to the bank that pays the amount of a check to the payee of the holder of the check. In carrying out this function, the paying banker is entitled to certain protections under the law to ensure that it does not become liable for wrongful payment of the check. One of the key protections available to the paying banker is the right of set-off. This allows the bank to offset any amounts owed to it by the drawer of the check against the amount of the check being paid. For example, if the drawer has an outstanding loan with the bank may offset the amount of check against the outstanding loan, thereby reducing its liability. Another protection available to the paying banker is the duty of the holder of the check to present it for payment within a reasonable time. The law places a duty on the holder of the check to present it for payment within a reasonable time, failing which the paying banker may not be liable for payment. The paying banker is also protected by the legal presumption that it has acted in good faith and without negligence in making payment of a check. This means that in the absence of any evidence to the contrary, the court will assume that the paying banker has acted correctly and is not liable for wrongful payment. In addition, the paying banker is entitled to rely on the apparent tenor of the check and is not required to investigate the underlying transaction or the authority of the person presenting the check for payment. This means that if the check appears to be valid on its face, a bank is entitled to make payment without further inquiry. Overall, the protections available to the paying banker are designed to ensure the bank is not unfairly held liable for the wrongful payment of a check. These protections help to maintain the integrity and stability of the banking system and provide confidence to customers in using checks as a means of payment. Kinds of LC. A letter of credit is a financial instrument used in international trade transactions to guarantee payment to the seller by a buyer's bank. There are several types of LCs that can be used in different situations. Revocable LC. This type of LC can be changed or cancelled by the issuing bank without consent of the beneficiary or the seller. It is not commonly used in international trade because it provides little security to the seller. Irrevocable LC. This type of LC cannot be changed or cancelled without the consent of all parties involved, including the beneficiary. It is the most commonly used type of LC in international trade because it provides security to both the buyer and the seller. Confirmed LC. In this type of LC, a second bank, usually the advising bank, confirms that it will honor the LC in addition to the issuing bank. This provides an extra layer of security for the beneficiary as it ensures that there are two banks guaranteeing the payment. Unconfirmed LC. This type of LC is only guaranteed by the issuing bank and does not have additional confirmation of another bank. It is typically used for smaller transactions where the risk of non-payment is low. Transferable LC. This type of LC allows the beneficiary to transfer all or part of the LC to a third party. This is useful when the beneficiary is acting as a middleman and needs to pay a supplier or a subcontractor. Back-to-back LC. This type of LC, two separate LCs are issued for a single transaction. The first LC is issued by the buyer's bank to the middleman, the beneficiary, and the second LC is issued by the middleman's bank to the supplier. This allows the middleman to act as both the buyer and seller at the same time, thus ensuring that both parties are protected. Standby LC. This type of LC is used as a form of insurance or a backup plan in case the buyer is unable to make payment. It is typically used in domestic trade and can be drawn on in the event of non-payment or default. Overall, the type of LC used will depend on the specific needs and requirements of the parties involved in the transaction. Crossed check. A crossed check is a type of check in which the drawer, the person who writes the check, has made two parallel lines on the face of the check. These lines may be either general, that is two parallel lines without any words or marks between, that is general crossing, or special crossing, where two parallel lines with words like account payee, not negotiable written between them. Crossing a check serves as a security measure to prevent the check from being fraudulently encashed or endorsed by someone other than the intended recipient. By crossing a check, the drawer is instructing the bank to only pay the check amount to the bank account of the payee and not to be cashed over the counter. There are two types of crossings, general and special. A general crossing is when the check is crossed with two parallel lines without any words between them. This means that the check can only be deposited into a bank account and cannot be cashed over the counter. A special crossing is when the check is crossed with two parallel lines with words like account payee are not negotiable between them. This means that the check can only be deposited into the account of the payee named on the check and cannot be endorsed over to any other person. In summary, a crossed check is a check that has two parallel lines on its face as a security measure to prevent fraud. The two types of crossing, general and special, specify how the check can be paid or deposited. Provide extra security to the payee and the bank. Banker's draft. A banker's draft, also known as a cashier's check or a treasurer's check, is a check that is guaranteed by a bank. It is a secure way to make large payments and the bank guarantees that the funds will be available when the check is presented for payment. When a customer requests a banker's draft, they provide the bank with the amount of payment plus any applicable fees. The bank then issues a draft which is drawn on the bank's own account and signed by one of its officials. The draft is made payable to the person or entity designated by the customer who can then use it to make a payment. Bankers draft are commonly used for large purchases such as property or vehicles as well as for international transactions. They are considered to be more secure than personal or company checks because the bank guarantees that the funds are available and will be paid. One advantage of using a banker's draft is that it can be used by people who do not have a checking account or who do not want to use their personal account for a large payment. Additionally, the recipient of the draft can be assured that the payment is genuine and will not bounce due to insufficient funds. However, there may be fees associated with obtaining a banker's draft and they may not be immediately available as the bank may need to verify the customer's account and the availability of funds. Fiduciary relationship. A fiduciary relationship is a legal and ethical relationship of trust and confidence between two parties, where one party, the fiduciary, is obligated to act in the best interest of the other party, the beneficiary, with respect to a particular matter. Fiduciary relationship arises in a variety of contexts, including but not limited to business, finance, law, medicine, and family. For example, a lawyer owes a fiduciary duty to their client, a trustee owes a fiduciary duty to the beneficiaries of a trust, and a financial advisor owes a fiduciary duty to their client. The fiduciary has a duty of loyalty, care, and good faith towards the beneficiary and must put the beneficiary's interest ahead of their own. This means that the fiduciary must act in an honest, impartial, and trustworthy manner and must not use their position for personal gain or advantage. The fiduciary must also exercise reasonable care and diligence in carrying out their duties and must avoid conflict of interest. The beneficiary, in turn, has a right to expect that the fiduciary will act in their best interest and will not take advantage of their position of trust. If the fiduciary breaches their duty or fails to act in the beneficiary's best interest, the beneficiary may have legal recourse to seek damages or other remedies. In summary, a fiduciary relationship is a special relationship of trust and confidence where the fiduciary has a duty to act in the best interest of the beneficiary. This relationship is based on principles of loyalty, care, and good faith and requires the fiduciary to avoid conflict of interest and to act with reasonable care and diligence. Blank endorsement. A blank endorsement is a type of endorsement on a negotiable instrument such as a check or a promissory note, in which the endorser simply signs their name on the back of the instrument without specifying any particular payee. This type of endorsement effectively turns the instrument into a bearer instrument, which means that it can be negotiated by anyone who has possession of it by just delivery. When a check or a promissory note is endorsed in blank, a person or entity who is in possession of the instrument can present it for payment to the bank or other institution that issued to it, or to any other party who is willing to accept it. Because the endorsement does not specify a particular payee, the instrument can be transferred from one person to another simply by passing it along. While a blank endorsement provides greater flexibility and ease of transfer, it also carries a higher risk of loss or theft, as anyone who has possession of the instrument can potentially cash or deposit it. To mitigate this risk, some parties may prefer to use a restrictive endorsement which specifies a particular payee and restricts the ability to transfer the instrument to others. Collecting banker. A collecting banker is the bank that collects payment on behalf of its customer from another bank or financial institution. When a customer deposits a check or other negotiable instrument into their account at one bank, but the check is drawn on another bank or a financial institution, the first bank may send the check to other bank for payment. The bank that receives the check for payment is called the collecting bank and it is responsible for presenting the check to the drawee bank and collecting payment on behalf of the customer's bank. The collecting banker may also charge a fee for the service which is usually deducted from the payment received from the drawee bank. In order to collect payment on behalf of the customer, the collecting bank must ensure that the check is properly endorsed and has not been altered or forged. The bank must also comply with all the applicable laws and regulations related to check processing and clearing. If the drawee bank refuses to pay the check or if there is some other problem with the payment, the collecting bank may be required to notify the customer and take other steps to resolve the issue. In summary, a collecting banker is a bank that collects payment on behalf of its customer from another bank or financial institution. The service is commonly used for checks that are drawn on other banks or financial institutions and allows customers to deposit these checks into their account and receive payment without having to physically visit the drawee bank. Banker set-off. Banker set-off refers to the right of a bank to use the funds that it owes to a customer to pay off a debt that the customer owes to a bank. In other words, if a customer has both a deposit account and a loan account with the bank may be entitled to set off the balance of the deposit account against the amount owed on the loan account. The right of set-off is generally based on the principle of mutuality, which means that the bank and the customer have a reciprocal relationship and obligations to each other. If the customer fails to meet their obligation to the bank may use the funds that it holds for the customer to satisfy these obligations. Set-off may be exercised by the bank without customer's permission. Although some legal jurisdictions may impose certain restrictions on the bank's ability to set off debts, In some cases, the bank may be required to give notice to the customer before exercising the set-off rights. The right of set-off can be a powerful and tool for banks to recover the outstanding debts owed by customers. However, it can also create a controversy and legal dispute if the customer disputes the amount owed or if there are questions about the validity of the set-off. As such, banks must exercise their right of set-off with caution and in accordance with all the applicable laws and regulations. Postal order. A postal order is a financial instrument that can be used to send money through the mail. If it is a type of money order issued by postal services such as US Postal Service or the Royal Mail of the UK, and is often used as a secure and convenient way to make payment or send money to others. A postal order is purchased by the sender for a specified amount and can be made payable to a specified recipient or left blank so that it can be cashed by the bearer. The sender then mails the postal order to the recipient, who can either cash it at a post office nearby or deposit it into their bank account. Postal orders typically have a fee associated with them, which is usually a small percentage of the total amount of the order. The fee may vary depending upon the amount of the order and the country where it is being sent. Postal orders are often used for transactions where other forms of payment are not accepted or are not considered secure, such as for online purchases or for sending money to someone who does not have a bank account. They can also be useful for people who do not have access to electronic payment methods or who prefer not to use them for security or privacy reasons. Overall, postal orders provide a secure and convenient way to send and receive money through the mail and are still widely used in many countries around the world. History of banking in India. Banking in India has a long and interesting history that dates back to ancient times. Some of the earliest forms of banking in India are informal systems of lending and borrowing, such as chit funds, hundis, and money lenders. During the colonial period, the British East India Company established several banks in India to support trade and commerce activities. The first modern bank in India was the Bank of Hindustan, which was established in 1770. It was followed by several other banks, including General Bank of India and Oriental Bank Corporation. In the late 19th and early 20th centuries, several Indian entrepreneurs established their own banks, such as Punjab National Bank and Bank of India. These banks played an important role in financing India's growing trade industry and in promoting economic development. After India gained independence in 1947, the government nationalized several major banks in an effort to promote economic development and expand access to financial services. This included the State Bank of India, which was established in 1955 as the country's largest commercial bank. Since then, the banking sector in India has undergone significant reforms and liberalization with the entry of private sector banks and foreign banks. Today, India has a diverse and dynamic banking sector with a mix of public sector banks, private sector banks, and foreign banks, as well as cooperative banks and regional rural banks. Overall, the history of banking in India reflects the country's long tradition of entrepreneurship, innovation, and economic development, as well as the ongoing efforts to expand financial inclusion and promote sustainable growth. Banker-customer relationship. The banker-customer relationship refers to the legal and contractual relationship between a bank, the banker, and its customer, who holds an account or uses the bank's services. This relationship is based on the principle of mutual trust, good faith, and confidentiality. As a part of this relationship, the bank provides various services to the customers, such as accepting deposits, providing loans, processing transactions, and providing investment and financial services. In return, the customer is expected to follow the bank's rules and regulations and maintain a minimum balance and pay fees and charges as applicable. The relationship between the banker and customer is governed by various laws and regulations, including the Indian Contract Act, Reserve Bank of India Act, and the Banking Regulation Act. And these laws provide the rights and responsibilities of both parties, including the duty of the bank to maintain the confidentiality of the customer's information and the duty of the customer to provide accurate and complete information to the bank. Overall, the banker-customer relationship is an important aspect of modern banking, as it helps to facilitate financial transactions and promote economic growth, while ensuring the safety and security of customers' funds and information. Negotiable instrument. Negotiable instruments are a type of commercial instruments or document that can be transferred from one person to another, either by delivery or by endorsement, or endorsement and delivery, in order to represent an obligation to pay a specific sum of money. Examples of negotiable instruments include promissory notes, bill of exchange, and checks. In order for a document to be considered a negotiable instrument, it must meet certain legal criteria, including 1. It must be in writing and signed by the maker or a drawer. 2. It must contain an unconditional promise or order to pay a specific sum of money. 3. It must be payable on demand or at a specified time or at a specified date. 4. It must be payable to a specific person or to the bearer or to the order. 5. It must be transferable from one person to another by delivery or by endorsement or endorsement and delivery. Negotiable instruments are widely used in commerce and finance as a means of transferring funds and financing business transactions. They offer advantages such as ease of transferability, certainty of payment, and legal enforceability. However, they also require careful handling and management in order to avoid fraud, forgery, and other forms of financial risk. Banker's lien. Banker's lien is a right that banks have over property or assets of a customer who has defaulted on a loan or is otherwise indebted to the bank. It allows the bank to retain possession of customer's property until the debt is repaid in full. Under banker's lien, the bank has the right to retain the property, securities, or valuables entrusted to it by the customer as security for any outstanding debt or liability. The lien is applicable to all types of accounts such as saving account, current account, fixed deposit, as well as safe deposit lockers. The banker's lien is a common law right and is recognized by courts in India. However, it is subject to certain limitations, such as the requirement that the bank must have given prior notice to the customer before exercising the lien. Additionally, the lien is limited to the amount of the outstanding debt, and the bank cannot sell or dispose of the property without customer's consent or a court order. Overall, the banker's lien is an important tool for banks to ensure repayment of debts and to protect their financial interest. However, it is important for customers to be aware of this right and to ensure that they meet their financial obligations in order to avoid the exercise of the lien by the bank. Traveler's checks. A traveler's check is a pre-printed fixed amount check that is designed to be used as a form of payment when traveling abroad. It is issued by a bank or a financial institution and is designed to be used by the person whose name appears on the check. Traveler's checks are typically denominated in major foreign currencies like US dollar, euro, or British pound. They can be used to pay for goods or services or can be exchanged for local currency at banks, hotels, or other financial institutions abroad. They are generally considered as a safe and convenient way to carry money while traveling, as they can be replaced if lost or stolen, and they are widely accepted around the world. Traveler's checks usually require the signature of the purchaser at the time of purchase, and a second signature is required when the check is used. This provides an added level of security and helps to prevent fraud. While traveler's checks were once a popular form of payment for travelers, their use has declined in recent years due to widespread availability of credit and debit cards, which offer greater convenience and flexibility. However, traveler's checks are still used by some travelers who prefer the added security and peace of mind that they provide. Promissory note. Promissory note is a written promise made by one party, known as the maker, to pay a specified sum of money to another party, known as the payee, on demand or at a specified future date. It is a largely binding document that serves as a form of debt instrument. A promissory note typically includes the following information: name of the maker and the payee, the date of the note, the amount of money being promised, the date or conditions under which the payment is to be made, the interest rate, if any, to be charged on the loan, any other terms and conditions of agreement. Promissory notes can be used for a variety of purposes such as personal loans, business loans, and financing of real estate transactions. They are often used as a means of formalizing and documenting a loan agreement between the parties. Once the promissory note is signed, it becomes largely binding a contract, and the maker is obliged to repay the amount of the note according to its terms. If the maker fails payment, the payee may have legal recourse to collect the debt, such as pursuing legal action or engaging the services of a collection agency. Payment in due course. Payment in due course is a legal concept that refers to the payment of a negotiable instrument such as a check or a promissory note by a party who has acted in good faith and without negligence, and who has no knowledge of any defects or irregularities in the instrument or in the transaction. Under Negotiable Instrument Act 1881, a payment made in due course is considered to be valid and discharges the obligations of the person making the payment. In other words, if a party makes a payment on a negotiable instrument in accordance with the general banking practices and procedures, and in the absence of any irregularities or defects, the payment is considered to be made in due course. For example, if a person presents a check to the bank for a payment and the bank pays the check after verifying the signature of the check matches the specimen signature on record and there are sufficient funds in the account to cover the payment is considered to be made in due course. However, if a payment is made with knowledge of defect or irregularities in the instrument or in the transaction, or if the payment is made with negligence or in violation of the usual banking practices, the payment may not be considered to be in due course, and the party making the payment may be held liable for any resulting loss or damage. Dividend warrant. A dividend warrant is a financial document that is used by a company to pay dividend to the shareholders. It is a check-like instrument that is issued by the company's dividend-paying agent or usually bank and is sent to the registered address of the shareholder. The dividend warrant typically includes the following information: name of the company, name of the shareholder, amount of the dividend being paid, the date of the warrant, and name of the dividend-paying agent. The shareholder can then deposit the dividend warrant into their bank account and cash it at a bank or other financial institution. Dividend warrants are usually issued to shareholders who do not have their dividends directly deposited into their bank account through a process known as electronic fund transfer. Instead, the company's dividend paying agent will mail the dividend warrant to the registered address of the shareholder. While dividend warrants were a popular method of paying dividends in the past, they are becoming less common due to widespread use of EFT and other electronic payment methods. Bank as an organ of country's development. Banks can play a significant role in the development of a country's economy. Here are some ways in which banks can function as an organ of country development. 1. Facilitating capital formation. Banks mobilize savings from the public and use them to provide credit to businesses and individuals for various purposes such as investment, production, consumption, and trade. This leads to formation of capital which can be used for productive purposes and contributes to economic development. 2. Providing financial services to the unbanked. Banks can provide financial services to individuals and businesses that currently are outside the formal financial system. This can help to increase financial inclusion and provide access to credit, savings, and other financial services. Promoting entrepreneurship. Banks can provide funding to entrepreneurs and startups to help them establish and grow their business. This can lead to the creation of jobs and the development of new products and services which can contribute to economic growth. Supporting infrastructure and development. Banks can provide funding for infrastructure projects like roads, bridges, and power plants. This can help to improve the country's infrastructure, which is essential for economic development. Providing financial stability. Banks can contribute to financing stability by providing a safe and secure place for individuals and the businesses to save their money. They can also provide liquidity in terms of financial crisis and help to stabilize the financial system. Overall, banks can play a crucial role in development of a country's economy by providing financial services, facilitating capital formation, promoting entrepreneurship, supporting infrastructure development, and providing financial stability. When can a bank dishonor a check? A bank may dishonor a check under certain circumstances, which include 1. Insufficient funds. If the account holder does not have enough funds in their account to cover the amount of the check, the bank may dishonor it. Account closure. If the account from which the check was drawn has been closed, the bank may dishonor the check. Signature mismatch. If the signature on the check does not match the signature on file with the bank may dishonor the check. Alterations or overwriting. If there are any alterations or overwriting on the check, the bank may dishonor it. Stale check. If the check is presented for payment after a certain period of time, usually 6 months, nowadays 90 days, the bank may dishonor it. Post-dated check. If the check is dated for a future date, the bank may dishonor if it is presented before the date mentioned on the check. Stop payment request. If the account holder has requested a stop payment on the check, the bank may dishonor it. In these situations, the bank has the right to refuse payment of the check and return it to the person who presented it. The person who presented the check may then have to take other steps to collect payment, such as contacting the account holder to arrange for payment or take legal action. It's called refer to drawer. The remark that is sent is refer to drawer. Characteristics of a negotiable instrument. A negotiable instrument is a type of commercial document that can be transferred from one person to another and used as a form of payment. Here are the main characteristics of a negotiable instrument. Transferability. A negotiable instrument can be transferred from one person to another by endorsement and delivery or endorsement and delivery, making it a valuable form of payment. Negotiability. A negotiable instrument can be bought, sold, or traded like any other commodity, that is called negotiation, without affecting its validity or enforceability. Unconditional promise or order to pay. A negotiable instrument contains an unconditional promise and order to pay a specific amount of money to the bearer or to a designated person or entity. Written instrument. A negotiable instrument is a written instrument typically signed by the person making promise or order to pay. Fixed amount. The amount of money promised or ordered to be paid on the negotiable instrument must be fixed and certain, or at least it should be possible to calculate it based on the formula given on the face of the instrument. Payment on demand or at a specific time. The payment on a negotiable instrument can either be on demand or at a specific time, depending on the terms of the instrument. Presumption of consideration. A negotiable instrument is presumed to have been issued for valuable consideration, which means that the person receiving the instrument is entitled to enforce it. These characteristics are important because they make negotiable instruments a reliable and secure form of payment that can be used in commercial transactions. They also make negotiable instruments easy to transfer and negotiate, which is important for the efficient functioning of the economy. Types of LC. There are several types of letter of credit that can be used in international trade. Some of the common types of LCs are revocable LC. This type of LC can be revoked or modified by issuing bank without the consent of the beneficiary. Irrevocable LC. This type of LC cannot be revoked or modified without the consent of all the parties involved, including the beneficiary. Confirmed LC. In a confirmed LC, a second bank, usually the beneficiary's bank, adds its confirmation to the LC, guaranteeing payment to the beneficiary even if the issuing bank fails to honor the LC. Unconfirmed LC. It's an unconfirmed LC. The beneficiary relies solely on the creditworthiness of the issuing bank for payment. Transferable LC. This type of LC allows the beneficiary to transfer all or part of the LC to another party, such as a supplier or a subcontractor. Back-to-back LC. In a back-to-back LC, a second LC is issued based on the first LC, allowing the beneficiary to use the second LC to pay a supplier for goods or services. Standby LC. This type of LC is used as a backup form of payment, typically to guarantee the performance or payment in case of default. It comes into force only once default occurs. Red clause LC. In a red clause LC, the beneficiary is allowed to receive an advance payment from the issuing bank before the goods are shipped. Green clause LC. In a green clause LC, the beneficiary is allowed to store the goods in a warehouse before shipment, and the LC can be issued to pay for the warehousing costs also. These type of LC provide flexibility for international trade transactions, allowing parties to customize the terms of LC to meet their specific needs. Mixed banking. Mixed banking refers to the system where a bank engages in both commercial banking and investment banking. Commercial banking activities include accepting deposit, lending money, providing other financial services to customer. Investment banking involves underwriting, issuing securities, managing investments, giving financial advice, and providing other financial advice and services to the clients. Mixed banking allows banks to diversify their activities, sources of revenue, or reducing their relationship. Mixed banking. Some countries like United States have implemented regulations to separate commercial and investment banking activities in order to mitigate these risks. Other countries like Canada and UK allow mixed banking but subject banks to stricter regulatory oversight and requirement to manage these risks. In India, you have banking and merchant banking. Merchant banking is carried out by a subsidiary of the main bank. That's the method we use in India. Subsidiaries manage the investment banking activities. Bill of exchange. Bill of exchange is a written order from one party known as the drawer to another party known as the drawee to pay a certain amount of money to a third party known as the payee at a specified time in the future. It is a negotiable instrument that can be transferred by endorsement and delivery and is commonly used in international trade transactions. A bill of exchange typically includes the following information: date of the bill, name of the drawer, that is the person ordering the payment, name of the drawee, the person who is to make the payment, name of the payee, the person who is to receive the payment, amount of money to be paid or the formula to calculate that amount, the date on which the payment is due, that is maturity date, any conditions or instructions regarding the payment. Once the bill of exchange is signed by the drawer and delivered to the payee, it becomes a legally binding obligation for the drawee to pay the specified amount to the payee on or before the maturity date. The payee can endorse the bill or transfer it to another party who can then endorse and transfer it again until the bill is finally presented to the drawee for payment. If the drawee fails to make the payment, the payee can take legal action to recover the amount owed. Days of grace. Days of grace refers to the additional period of time that is allowed for the payment of a bill of exchange or a promissory note beyond its due date. It is a custom that has traditionally been followed in some countries and legal systems, although it is not universally recognized or practiced. The days of grace are typically 3 days and they are added to the maturity date of the bill or note. For example, if a bill is due on June 1 and has 3 days of grace, the payment will be considered on time if it is made by June 4. During the days of grace period, the holder of the bill or a note cannot take legal action against the drawer or acceptor for non-payment. The purpose of days of grace is to provide some flexibility and leeway for the parties involved in a transaction, particularly in situations where the payment may be delayed due to factors beyond their control, such as unforeseen circumstances or difficulties in transferring funds. However, some critics argue that days of grace can be confusing and unnecessary and that they can contribute to delays and disputes over payment. Blank endorsement. A blank endorsement is a type of endorsement that is made on the back of a negotiable instrument such as a check or a promissory note without specifying the name of the person to whom the endorsement is made. It simply consists of the endorser's signature and it effectively transforms the instrument into a bearer instrument, which can be transferred to any person who possesses it. By endorsing a check or other negotiable instrument in blank, the endorser is authorizing the payment to be made whoever who is in possession of the instrument. This means that the check or a note can be negotiated multiple times by simply passing it from one person to another without need for any further endorsements. Blank endorsement can be risky as they provide a greater degree of flexibility and convenience but also increase the possibility of fraud or misuse. If a blank endorsed check or a note is lost or stolen, it can be easily encashed by anyone who finds it or steals it. Therefore, it is generally recommended that individuals exercise caution when endorsing negotiable instruments and consider using alternative methods such as restrictive endorsement or ensure greater security and control over their financial transactions. Banking. Banking refers to the industry and profession that deals with the management, investment, and safekeeping of money, as well as the provision of financial services to individuals, businesses, and other organizations. Banks serve as intermediaries between depositors who entrust their money to the bank for safekeeping and borrowers who seek loans or other financial services from the bank. Banks perform a wide range of functions and services, including 1. Accepting deposits. Banks offer various types of deposits such as saving accounts, checking account, time deposit, which pay interest to depositors based on the amount and duration of the deposit. Providing loans. Banks lend money to individuals and businesses for various purposes such as purchasing homes, financing businesses, and funding education. Processing payment. Banks facilitate the movement of money by providing payment services such as electronic fund transfer, wire transfer, and credit card processing. Managing investments. Banks help individuals and businesses invest their money by offering various investment products like mutual funds, stocks, and bonds. Providing financial advice. Banks offer financial advice and guidance to individuals and businesses, helping them make informed decisions about their money and investments. Overall, banking plays a critical role in global economy, providing essential financial services and contributing to economic growth and development. Liquidity. Liquidity refers to the case with ease with which an asset can be converted into cash without causing significant impact on its market value. In other words, it measures the ability of an asset to be quickly and easily sold in the market for cash. For individuals, liquidity is important because it allows them to access cash quickly when needed, such as in the case of an emergency or unexpected expense. For businesses, liquidity is crucial for meeting short-term obligations such as paying bills and salaries and for taking advantage of new business opportunities. In the financial markets, liquidity is important for maintaining an orderly and efficient market. Highly liquid markets allow investors to buy and sell assets quickly and easily without significantly impacting their prices. Low liquidity markets, on the other hand, may lead to significant price fluctuations, making it difficult for investors to buy or sell assets. Overall, liquidity is a critical concept in finance and plays a key role in functioning of the financial markets and economy as a whole. Bankers Clearinghouse. A Bankers Clearinghouse, also known as a clearinghouse or a clearing association, is a financial institution that facilitates the exchange of settlement of financial transactions between banks. The primary purpose of a clearinghouse is to simplify and streamline the process of clearing and settling financial transactions between banks. In India, it is an association of banks. It is a society registered under Societies Act. A clearinghouse acts as an intermediary between banks and allowing them to exchange financial instruments such as checks, drafts, and electronic transfers. The clearinghouse processes and verifies the transactions and checks for sufficient funds in the bank's accounts and settles the transactions by transferring funds between banks' accounts. Normally, it is done through an account maintained with the president of the clearinghouse. President can be a State Bank of India, with which all other banks maintain their accounts, or Reserve Bank of India in a state headquarters, where the DAD maintains an account. Clearinghouses can operate on a national or a regional level and are often owned and operated by banks themselves. In some cases, clearinghouses may be operated by third-party organizations or by government entities or Reserve Bank of India. In providing a centralized and secure system for exchanging and settling financial transactions, clearinghouses help to reduce the risk and costs associated with interbank transactions. They also facilitate the smooth functioning of financial system by ensuring that funds are transferred quickly and efficiently between banks. Indigenous banker. The term indigenous banker typically refers to a person or entity that provides financial services to underserved communities in rural and remote areas. These individuals and entities may not be traditional banks, but rather local community members or organizations that have stepped in to fill the gap left by large financial institutions. Indigenous banks are often operate in areas where there is limited access to traditional banking services, either due to geographical isolation or economic factors. They may offer a range of financial services, including microloans, saving accounts, and remittances, to help individuals and small businesses access the financial resources they need to be accused. Indigenous bankers may also play an important role in preserving local culture and tradition. They often have deep ties in the community they serve. By providing financial services that are tailored to the needs of these communities, indigenous bankers can help to promote economic development and reduce poverty in some of the world's most vulnerable regions. DP Note. DP Note stands for Delivery Payment Note. Demand Promissory Note. It is a delivery payment note or a demand promissory note. It's a type of negotiable instrument used in international trade finance. DP notes are typically used in situations where a buyer and seller agree to a transaction, but the buyer wants to ensure that they receive the goods before making the payment. Under DP note, the seller ships the goods to the buyer and presents the shipping documents to their bank along with the DP note. The bank then releases the shipping documents to the buyer, who can use them to take possession of the goods from the carrier. The buyer then has a specified period of time known as the DP period to make the payment for the goods. If the payment is not made within DP period, that is, it is DA, the seller's bank may exercise its right of recourse against the buyer, which may include legal action to recover the outstanding amount. DP notes are often used in international trade transactions as a way to mitigate the risk of non-payment or fraud, as they provide a mechanism for ensuring that the buyer receives the goods before making payment. Conditional endorsement. Conditional endorsement is a type of endorsement that is made on a negotiable instrument such as a check or a promissory note that imposes certain conditions on the transfer of the instrument. In a conditional endorsement, the endorser places certain restrictions on the use or transfer of the instrument. An endorsement is only valid if these conditions are met. For example, a check may be endorsed conditionally with the words "for deposit only," which means that the check can only be deposited into endorser's account and cannot be cashed. Another example in the endorsement that is made with the condition that the funds will only be released once the certain conditions are met, such as the completion of a project or receipt of a specified document. Conditional endorsement can provide additional security and control for the endorser, as they can limit the use or transfer of the instrument to certain specified purposes. However, they can also limit the flexibility and transferability of the instrument, which may make it less attractive to potential holders or buyers. Account payee. Account payee is a term used in banking to indicate the payment made by a check or other negotiable instrument to intended for account of the payee only and cannot be transferred or cashed by anyone else. When a check is marked account payee, it means the payment is only intended for the person or entity whose name is written on the check and they must deposit it into their own account rather than cashing it. This helps to prevent fraud and ensures that the payment is received by the intended recipient. In some countries, including India, account payee is used instead of account payable or pay into the order of, which are commonly used in other parts of the world to indicate that the check can be deposited or transferred to a third party. Bank. A bank is a financial institution that provides various types of financial services, including accepting deposits, making loans, offering other financial products and services to individuals and businesses and other organizations. Banks play an important role in the economy by providing a safe and secure place for people to store their money and by providing loans and other financial services that help individuals and businesses to invest in and grow their activities. Banks typically offer a range of financial products and services, including checking and saving accounts, credit cards, personal loans, mortgages, business loans, investment accounts, wealth management services. Banks also serve as intermediaries between borrowers and lenders and help to facilitate transactions between individuals and businesses across different regions and countries. Banks are subject to regulation by government authorities and must follow strict rules and regulations to ensure the safety and security of their customers' funds. They also play a key role in the payment system and help to facilitate transactions between individuals and businesses by providing payment processing services and issuing various types of payment instructions like checks, credit and debit cards, and electronic payment systems. Law of banking. The law of banking refers to a set of legal rules and regulations that govern the operations and activities of banks and other financial institutions. This includes laws related to formation and regulation of banks, the conduct of banking transactions, and rights and obligations of the banks and other customers. The law of banking is a complex and rapidly evolving area of law, as banking and financial services are subject to constantly changing economic and technological and regulatory conditions. Banks must comply with a wide range of laws and regulations at both national and international levels, including laws related to banking and finance, consumer protection, data privacy, anti-money laundering, and counter-terrorist financing. Some of the key legal issues that arise in the context of banking include the creation and enforcement of contracts between banks and their customers, the regulation of banking operations and activities, including capital requirements, lending practices, and provision of financial services, the protection of consumers and prevention of fraud and other illegal activities, the resolution of dispute between banks and their customers and between banks and other financial institutions, the management of risk and prevention of systematic financial crisis. Overall, the law of banking plays a critical role in ensuring the safety, stability, and efficiency of the banking system and protecting the interests of the consumers and investors. In India, the law of banking includes Negotiable Instruments Act, Law of Contract, then you have Banking Regulation Act 1947, then Reserve Bank of India Act, and SEBI Securities Exchange Board of India Act, and the like. Forgery. Forgery is the act of creating a false or fraudulent document or signature with the intent to deceive someone. Within the context of banking, forgery often involves the creation of a false signature on a check, promissory note, or other negotiable instrument. Forgery is a serious crime that can result in serious IPC crime that can result in significant legal consequences, including fine, imprisonment, and civil liability. Banks take forgery very seriously and have a number of measures in place to prevent and detect it, including the use of signature verification and other security protocols. If a bank suspects that a signature or document is forged, it will typically reject the transaction and notify the account holder or other relevant parties. Bank may also initiate legal proceedings against the person or entity responsible for forgery, or it may refer it to the police. Overall, forgery is a serious issue in the banking industry and can have significant consequences for individuals and institutions involved in fraudulent activities. It is important for banks and other financial institutions to have robust security measures in place to prevent and detect forgery and to work closely with law enforcement agencies to investigate and prosecute cases of fraud. Crossed check, repeated request. A crossed check is a type of check that has two parallel lines drawn across its face. The crossing of these lines indicate the check must be paid only into a bank account and cannot be cashed over the counter. This provides an additional layer of security to prevent fraud and ensure the funds are properly credited to their current account. Crossed checks can be further classified into two types: general crossing and special crossing. In a general crossing, the crossing is crossed between two parallel lines and the words "and co" are not negotiable may also be used. This means that the check can only be deposited into the account of the payee and cannot be further endorsed to another person. The words "not negotiable" also mean the payee cannot transfer or assign the check to someone else. In a special crossing, the check is crossed with the name of the particular bank. This means that the check must be presented into an account with that of the bank, providing an additional layer of security for the payee. Overall, crossed checks are an important tool for preventing fraud and ensuring that funds are properly credited to the correct account. They provide an additional layer of security for both the payer and the payee and help to promote trust and confidence in the banking system. Trustee. A trustee is a person entity that holds and manages property or assets for the benefit of another person or group of people. The trustee is responsible for managing the assets in accordance with the wishes of the person who created the trust, or the grantor or a settlor, as set out in the trust agreement. Trustees are often appointed to manage assets for the benefit of minors, people with disabilities, and other individuals who are not capable of managing their own affairs. They may also be appointed to manage assets on behalf of charity or other non-profit organization. In carrying out their duties, trustees have a fiduciary duty to act in the best interest of the beneficiaries of the trust. This means that they must manage the assets properly, avoid conflict of interest, and act in accordance with the terms of the trust agreement. Trustees may be compensated for their services either through a fee or a percentage of the assets under management. They may also be held liable for any losses or damages that result from their failure to fulfill their duties as trustee. Protection to paying banker in law. In banking law, a paying banker is a bank that pays a check or other negotiable instrument drawn on it by one of its customers. The paying banker is legally protected under certain circumstances which are outlined in the Negotiable Instrument Act. According to this act, paying banker is discharged from liability for paying a check in the following circumstances: if the payment is made in due course and in good faith, if the check is paid in the usual course of business, and the paying banker has no reason to believe that the payment is improper, then the banker is protected from any liability for making the payment. If the payment is made before the check is revoked, if the check is presented for payment and the banker pays it before the customer revokes it, then the banker is not liable for making the payment. If the payment is made before the banker has notice of the customer's death, if the customer dies before the check is presented for payment, but the banker is not aware of the customer's death and pays the check, then the banker is not liable for making the payment. If the payment is made before the banker receives notice of the customer's insanity, if the customer becomes insane after issuing the check, but the banker is not aware of the customer's insanity and pays the check, then the banker is not liable for making the payment. If the payment is made before the banker receives notice of the customer's bankruptcy, if the customer becomes bankrupt after issuing the check, and the banker is not aware of the customer's bankruptcy and pays the check, then the banker is not liable for making the payment. In all these circumstances, the paying banker is protected from liability for making payment. However, if the payment is made in violation of any of these protections, then the paying banker may be liable for any resulting liabilities. Garnishee order. A garnishee order is a legal order that allows a creditor to collect a debt owed by a debtor directly from a third party who owes the money to the debtor. The third party is called the garnishee, in this case the bank. In the context of banking, the garnishee order can be issued to collect a debt owed by a bank customer. For example, if a bank customer owes money to a creditor and the creditor obtains a garnishee order against the bank may be required to freeze the customer's account and pay the creditor the amount owed from the account. The garnishee order is a powerful tool for creditors as it allows them to collect debts more quickly and easily. However, the garnishee order must be properly obtained through the court system and served on the garnishee in order to be enforceable. Additionally, bank may have certain legal protections that limit the amount of funds that can be garnished in the circumstances under which a garnishee order can be enforced. NABARD. NABARD, or the National Bank for Agriculture and Rural Development, is a developmental financial institution in India. It was established in the year 1982 by an Act of Parliament with the objective of promoting rural development and agriculture in the country. NABARD's main functions include providing credit to rural areas, promoting research and development in agriculture, supporting the development of rural infrastructure. NABARD also serves as a regulatory body for the cooperative banking sector in India and provides training and consultancy services to various stakeholders in agriculture and rural development sectors. Additionally, NABARD plays an important role in implementation of the government policies, RIDF funds, especially building rural infrastructure related to agriculture and rural development, and works closely with the state government and other institutions to achieve its objectives. Current account. Current account is a type of account that allows customers to deposit and withdraw money as frequently as they want. It is typically used by businesses, companies, and individuals who have high volume of transactions on a regular basis. It does not pay any interest to the depositor, but in fact it charges money for maintaining the account. Unlike a savings account, which is designated to help customers to save money and earn interest on their deposit, current account is primarily used for managing day-to-day transactions like payment, withdrawal, and transfer. Current account usually offer features like overdraft facility, checkbook, and online banking services to facilitate convenience of transactions. Since the current account is designed for frequent transactions, it generally doesn't carry any interest on the balance in the account. In some cases, however, banks may offer interest on current account balances above a certain threshold. The account holder is also usually required to maintain a minimum balance in the account, failing which the bank may levy a penalty or a charge. Bank may also charge for the number of transactions or number of ledger folios that are used per year. Bank customer. A bank customer is an individual, business, or organization that has a relationship with a bank, which involves utilizing banking services offered by the bank. The banking services offered to customers by a bank may include the opening of a savings or current account, provision of loans and credit facilities, issuance of credit or debit cards, and other financial services. To become a bank customer, an individual or organization usually needs to meet certain criteria set by the bank, which may include submitting the necessary documents for identity verification and fulfilling other requirements such as a minimum balance maintenance, credit worthiness, and compliance with anti-money laundering regulations. Bank customers may use various banking services for different purposes such as depositing money, withdrawing money, transferring funds to other accounts, making payments, and managing their finances through online or mobile banking services. In return for using these services, customers may be charged fees, interest rates, and other charges by the bank. Receipts. A receipt is a written or electronic document that acknowledges that a certain amount of money or goods that have been received by the recipient from the payer. It serves as a proof of payment or transaction, providing evidence of the exchange of goods or services for a certain amount of money. Receipts can be used for both personal and business transactions. A receipt typically includes the date of transaction, the name of the payer and the recipient, a description of the goods or services received, the amount paid, and any applicable taxes or fees. It may also include the payment method such as cash, credit, card, or check. In business transactions, receipts are important for record-keeping purposes and providing evidence of expenses for tax and accounting purposes. In personal transactions, receipts may be necessary for returning or exchanging goods or for claiming warranty or insurance. Electronic receipts or e-receipts are becoming increasingly common, particularly for online purchases and transactions. These are often emailed or texted to the customer, providing an electronic record of the transaction that can be easily stored and retrieved. Passbook. A passbook is a small booklet or record that is issued by a bank to its savings or current account holder. It contains a record of all the transactions, including deposits, withdrawals, interest earned, and other service-related transactions made by the account holder with the bank. The passbook acts as a proof of transactions, and the account holder needs to present it to the bank whenever they make any transaction. It helps the account holder to keep track of their account balance and transaction. The passbook is updated by the bank after every transaction, and the account holder can view their latest account balance by checking their passbook. Nowadays, with the advent of internet banking and mobile banking, banks have started offering e-passbooks or m-passbooks or digital passbooks and allow account holders to view their transactions and account balance online. Assignment of a bank account. Assignment of a bank account refers to the transfer of ownership or interest in the bank account from one person to another. This can be done through a legal process called assignment, whereby the account holder or the assignor transfers all or part of their rights and interest in the account to another person, the assignee. In case of a bank account, assignment usually takes the form of a written agreement or a deed between the assignor and the assignee, which sets out the terms of the transfer. The assignee may be granted access to the account or may receive right to receive funds in the account. It is important to note that the assignment of a bank account may be subject to legal restrictions such as those related to bankruptcy and insolvency proceedings or those imposed by the bank itself. In addition, banks may require proof of legal documentation and verification of the identity of the parties involved in the transfer before allowing the assignment of the account to take place. Effect of nationalization of banks. Nationalization of banks in India has a significant impact on the country's economy and banking system. Here are some. Increased government control. After nationalization of banks, the government became the majority shareholder in these banks, giving it greater control over their operations and management. Expansion of banking services. Nationalization led to the expansion of banking services, especially in rural areas. Government used the nationalized banks to increase access to banking services and to promote financial inclusion. Promotion of priority sector lending. Nationalized banks were required to allocate 16% of their lending to the priority sector like agriculture, small-scale industries, exports, which help to promote these sectors. Reduction in the concentration of economic power. Nationalization helped to reduce the concentration of economic power by breaking the monopoly of a few private banks and promoting competition. Improvement on the health of the banking system. Nationalization helped to improve the health of the banking system by strengthening regulation, improving governance, and reducing the risks of bank failure. Not a single big bank failed. Employment generation. Nationalization led to increased employment opportunities as the nationalized banks expanded their operations and opened new branches. Development of infrastructure. Nationalized banks played a significant role in financing the development of infrastructure, including power projects, highways, and railways. Overall, the nationalization of banks in India were a significant step in the country's economic development and helped to promote financial inclusion, social justice, and economic growth. Kinds of endorsement. There are several kinds of endorsement used in banking transactions. Some of the common ones are blank endorsement. In this type of endorsement, the endorser just signs on the back of a check and instrument without specifying the name of the endorsee. This makes the instrument payable to the bearer. Anyone who holds the instrument can claim the payment. Special endorsement. Special endorsement specifies the name of the endorsee and makes the instrument payable only to that person. The endorsee can further endorse the instrument to another person or deposit it in his bank account. Restrictive endorsement. Restrictive endorsement is used to limit the negotiation of the instrument. For instance, if a check is endorsed for deposit only, the bank can only deposit the funds into an account of the endorsee and cannot pay the check in cash. Conditional endorsement. A conditional endorsement specifies a condition for the payment of the instrument. For example, an endorsement may state that the check is payable only when a certain event occurs or when a particular person signs the instrument. Facultative endorsement. A facultative endorsement is one where the endorser undertakes to pay the instrument in case the original debtor fails to make the payment. It's similar to a guarantee. Purpose of crossing a check. The purpose of crossing a check. The crossing of a check is a practice used to provide additional security and prevent fraudulent activities related to the payment of a check. The primary purpose of crossing a check is to make sure that the payment is made only to the intended recipient and not to any unauthorized person. When a check is crossed, it means a drawer has instructed the bank to pay the check amount only to a particular bank or a branch and not to be paid over the counter in cash. Therefore, crossing a check helps to ensure that the check proceeds are credited to the account of the payee and not misused by any unauthorized person. There are different types of crossings like general crossing, special crossing, restrictive crossing, which can be used as per the need of the drawer. Crossing a check is an important aspect of banking and financial transactions, and it provides a level of security for both drawer and the payee. Inchoate instrument. Inchoate instrument. An inchoate instrument refers to a legal document or a financial instrument that is incomplete or not yet fully formed. In other words, an inchoate instrument is a document that has been created but not yet finalized or made legally effective. Examples of inchoate instrument include a draft of a contract that has not been signed by both parties, a partially completed promissory note, or a check that has not been signed or has not been completed with the necessary information. In most cases, an inchoate instrument is not legally enforceable until it has been completed or signed by all the parties involved. Until then, it is considered a preliminary document that does not have any legal effect. However, some inchoate instruments can be legally binding even if they are not fully executed. For example, an offer made in a draft of a contract can be binding if it meets the legal requirements of a valid offer and has been accepted by the other party. Inchoate instruments are important to understand in legal and financial context as they can have significant implications for the parties involved and the enforceability of any agreement or obligations created. Liability of a drawer of a check. Liability of a drawer of a check. The drawer of a check is the person who writes the check and signs it. They are primarily responsible for ensuring that there are sufficient funds in their account to honor the payment when the check is presented for payment. If there are insufficient funds or if the check is dishonored or if the check is for any other reason, The drawer can be held liable for resulting losses or damages. Under the provisions of Negotiable Instrument Act, the liability of the drawer of a check arises in case of a dishonor of a check due to insufficiency of funds or any other reason such as signature mismatch, overwriting, or alteration of the check. The holder of the check can file a complaint against the drawer under Section 138 of the Act, which provides for a criminal penalty for a dishonor of a check. If the complaint is proved, the drawer can be punished with imprisonment for a term which may extend up to 2 years and with a fine or with both. In addition to the criminal penalty, the drawer may also be liable to pay damages or compensation to the holder of the check for any loss or damages suffered due to the dishonor of the check. Therefore, it is important for the drawer to ensure that they have sufficient funds in their account before issuing a check and to take care to avoid any errors or irregularities in the check that could lead to its dishonor. Cooperative Bank. A cooperative bank, also known as the Cooperative Credit Institution, is a financial institution that is owned and operated by its members. These banks are formed as cooperative societies with the aim of providing financial services and support to their members and communities. Cooperative banks operate on the principle of cooperation and mutual assistance with the object of meeting the financial needs of their members. They typically offer a range of banking services like deposits, loan, other financial services. Cooperative banks are typically focused on meeting the financial needs of the local community and promoting economic development. In India, cooperative banks are regulated by the Reserve Bank of India under Banking Regulation Act 1949. Cooperative banks in India are divided into two categories: state cooperative banks and urban cooperative banks. State cooperative banks and then operate in the state level and provide banking services to the rural and agriculture sector. Urban cooperative banks operate in the urban and semi-urban areas, provide banking services to the general public. Cooperative banks have a unique role in financial system as they are owned and controlled by their members and operate with the aim of promoting economic development and social welfare. They are often seen as an important source of credit and financial services for small businesses and low-income individuals who may not have access to traditional banking services. Banking Ombudsman. Banking Ombudsman is an independent dispute resolution mechanism for customers for banks in India. It is a mechanism that provides customers with an avenue to raise their complaints against the banks and seek redress for their grievance. The Banking Ombudsman is appointed by Reserve Bank of India under Banking Ombudsman Scheme 2006. The scheme covers all banks operating in India, including public sector banks, private sector banks, and foreign banks. Customers can approach the Banking Ombudsman for any grievance related to the banking services like non-payment or delay in payment of check, non-adherence to RBI directives or interest rates, failure to provide ATM services, or any other issues related to banking services. The Banking Ombudsman also handles complaints related to loans, deposits, and credit cards. Banking Ombudsman has the power to investigate complaints and issue awards to provide relief to the customers. Awards may include monetary compensation, corrective action by the bank, any other relief deemed fit by the Banking Ombudsman. The Banking Ombudsman is an important mechanism to ensure that the customers have a fair and transparent access to address their grievances against banks. It provides a quick and effective resolution of disputes between the customers and banks and promotes the trust and confidence in the banking system. Kinds of endorsement. Endorsement, also spelled as endorsement, is an act of signing of the bank of a negotiable instrument, such as a check or a bill of exchange, to transfer the ownership to give authorization to another person to receive payment. There are different kinds of endorsement which are as follows: blank endorsement, special endorsement. A special endorsement is made. Blank endorsement is only signature on the back. Special endorsement is made by signing on the back of the instrument and specifying the name of the person to whom the instrument is to be transferred. The instrument can only be negotiated to the specified person or their order. Restrictive endorsement. A restrictive endorsement is made by adding words such as "for deposit only" or "not negotiable" along with the signature of the back of the instrument. This type of endorsement limits the negotiability of the instrument and restricts its use. Endorsement in full. An endorsement in full is made by signing on the back of the instrument and specifying the name of the person to whom the instrument is to be transferred, as well as indicating that the transfer is without recourse or liability to the endorser. With recourse, without recourse. It can be both. Conditional endorsement. A conditional endorsement is made by adding conditions to the transfer of the instrument. The transfer of the instrument is subject to fulfillment of conditions specified in the endorsement. These different types of endorsement are important in negotiable instruments as they determine the rights and liabilities of the parties involved in the transfer of the instrument. Noting and protest. Noting and protest are terms used in the context of negotiable instruments such as bill of exchange, promissory note, and check. These terms are related to the non-payment or dishonor of a negotiable instrument. Noting in the process of recording the fact of dishonor of a negotiable instrument by the holder or the authorized party on the instrument itself, or on a separate sheet of paper calling noting memorandum. The noting memorandum contains details of the dishonor such as the date and place of dishonor, reason for dishonor, and the signature of the notary public or other authorized party. Noting is the formal and legal process and serves as an evidence of dishonor of the instrument. Protest is a further step taken after noting which involves the formal declaration of dishonor of the negotiable instrument by a notary public. A notary public is a public official who is authorized to administer oath, witness signature and attest to the authenticity of document. A protest is made by the notary public by recording the details of the dishonor and the reasons for dishonor and by presenting the protest notice to the drawer, acceptor or endorser of the instrument. A protest serves as a conclusive evidence of dishonor of the instrument and it can be used as legal proceedings to establish liability of the other party. Drawer or acceptor. Noting and protest are important steps in the process of recovering the amount due on a negotiable instrument and they are necessary to establish the liability of the parties involved in the transaction. These steps also serve as a warning to the other parties who may consider dealing with the defaulting party in future. Foreign instrument. A foreign instrument is a negotiable instrument such as a bill of exchange, promissory note, a check that is drawn and made payable outside of the country in which it is presented for payment or negotiation. For example, a bill of exchange that is drawn in the United States and payable in India would be considered a foreign instrument in India. Foreign instruments are subject to different laws and regulations in different countries and they may require additional documentation and verification before they can be negotiated or paid. The process of negotiating or paying a foreign instrument may involve the use of international banks and conversion of currency. The negotiation or payment of foreign instrument may also be subject to fees or charges such as exchange rates and commission charges which can affect the amount that the holder of the instrument ultimately receives. Khargamwala NI Act. LexisNexis. Preamble of NI Act, 1881 Act. Whereas it is expedient to define and amend the law relating to promissory notes, bill of exchange, and checks, it is hereby enacted. Khargamwala NI Act. It extends to the whole of India. Before passing of the Indian Independence Act 1947, NI Act 1881 extended to the whole of British India, including all territories and places with His Majesty's dominions, which were for the time being governed by His Majesty through Governor General of India. Since Section 18, Clause 3 of the Independence Act 1947 provided that save as otherwise expressly provided in the Act, the law of British India and of the several parts thereof existing immediately before the appointed day shall, so far as applicable and with necessary adaptations, continue as the law each of the new dominions and several parts thereof until other provisions is made by the laws of the legislature or authority having power in that behalf. Presently, under Article 372 of the Constitution of India, all legislations in force in the territory of India immediately before the commencement of the Constitution shall continue to have effect until altered or repealed or amended by a competent legislature or other competent authority. Article 246 of the Constitution endows Parliament with the exclusive power to make laws with respect to any of the matters enumerated in List 1 Union List in the 7th Schedule. Entry 46 in Union List comprises bills of exchange, checks, promissory notes and other like instruments. Entry 45 of the list relates to banking. So 45, 46 of List 1. The law pertaining to negotiable instruments and banking thus falls within the exclusive jurisdiction of Parliament, which alone can alter or amend the Act. It is important to note the powers of Parliament and of the state legislature to enact laws regarding bills of exchange, checks and promissory notes. The question whether the state legislatures is including law relating subjects with their own list had transgressed their jurisdiction and incidentally encroached upon the jurisdiction of the federal subjects under the Government of India Act 1935 was decided by the Supreme Court in State of Bombay versus Narottam Das. In that case, the plaintiff instituted a suit in High Court of Bombay for recovery of 11,000 rupees on the basis of a promissory note. He contended that the Bombay City Civil Court Act 1935 enacted by the provincial legislature was ultra-vires. The Government of India Act 1935 as the subject of promissory notes was covered by Entry 53, List 1 of the 7th Schedule of the Government of India Act 1935. It was held that the impugned Act was in pith and substance a law with respect to the matter enumerated in List 2, Entry 2, read with Entry 1 of the 7th Schedule of the Government of India Act 1935. And hence not ultra-vires, and the fact that incidentally it affected suits relating to promissory notes, subject falling with entry as 2853 of List 1, would not affect its validity. A similar issue of translation of power arisen before the Privy Council in Prafulla Kumar Mukherjee versus Bank of Commerce Limited, Khalna. In that case, the Bengal Money Lenders Act enacted by the provincial legislature, which restricted the amount of loan and interest that may be recovered from the debtor with retrospective effect, was challenged, being ultra-vires the Government of India Act 1935 as the subject of negotiable instruments and banking was covered in entries List 1. It It was held that the impugned act was in pith and substance a law with respect to the matter enumerated in list 2 dealing with money lenders and money lending and for relief of debtors and hence not ultravirus, and the fact that incidentally it affected matters in list 1 would not affect its validity. Indian Paper Currency Act 1871. The Act does not affect the provisions of Section 21 of the Indian Paper Currency Act 1871. The Act of 1871 was followed by a succession of paper currency legislations, and the last being Indian Paper Currency Act 1923, which was repealed by the Reserve Bank of India Act 1934. Section 21 of the Act 1871 has been reenacted with slight modifications under Section 31 of the Reserve Bank of India Act 1934, which, as amended in Article 20, reads as, no person in India other than the bank or as expressly authorized by this Act, the central government shall draw, accept, make or issue any bill of exchange, hundi, a promissory note or engagement for the payment of money payable to bearer on demand, or borrow, owe or take up any sum or sums of money on the bills, hundis or notes payable to bearer on demand of any such person, provided that checks or drafts including hundis payable to bearer on demand or otherwise may be drawn on a person's account with a banker, shop for an agent. Notwithstanding anything contained in Negotiable Instrument Act 1881, no person in India other than the bank or as expressly authorized by this Act, the central government shall make or issue any promissory note expressed to be payable to the bearer of the instrument. The object of the paper currency legislation was to prevent banks and private persons from infringing the government monopoly over the issuance of paper currency in India. The monopoly has now been vested in the Reserve Bank of India in certain cases, in the central government in others, that is rupee 1, central government, others, Reserve Bank of India. Payable to bearer on demand means anybody can get payment even without an endorsement from the holder of the note. The section allows the issues of bearer checks on bank accounts but disallows bank drafts made payable to bearer. You can give a bearer check but you cannot give a bearer draft. Local usage. The Act does not apply to any local custom relating to any instrument in Oriental language. The Act applies to promissory notes, bills of exchange and checks. But where the instrument is in Oriental language, example a hundi or a rukka, any local usage relating to such instrument applies notwithstanding the provisions of the Act. The saving clause does not render the Act altogether inapplicable to hundis. It is only where there is a local usage to the contrary that the local usage overrides the provisions of the Act. The said usage must be alleged and established by the party relying on it. In the absence of proof as to the existence of any such usage, the Act applies as much as to hundis as to instruments in English. Such local usage may, however, be excluded by incorporating a specific clause in the body of the instrument indicating an intention that the legal relations of the parties thereto shall be governed by the Act, which the case the local usage shall cease to operate. By excluding the applicability of the Act to instruments in Oriental languages, unnecessary confusion in the state of law has been established. The law of negotiable instrument being closely related to the commercial world should be by and large uniform in its application. The Law Commission of India has also suggested that the instruments drawn in Oriental language which fulfill the requirements of instruments dealt with under the Act should also be governed by the Act. Interpretation clause. Banker. Banker includes any person acting as a banker in any post office, savings bank. Banker. The Act does not define the term banker. In one of the early cases it was held that a banker is a person who receives the money of his customer to be drawn out again as the customer has occasion for it. The customer being the lender and the bank being the borrower, with the superadded obligation of honoring the customer's checks up to the amount of money received and still in the banker's hands. It, as per Pagets' Law of Banking, stated, it is therefore a fair deduction that no one and nobody, corporate or otherwise, can be a banker who does not open current accounts, pay checks drawn on himself and collect checks for his customers. The United Dominions Trust Limited versus Kirkwood. The characteristics usually found in modern bankers were stated to be: they accept money from and collect checks for their customers and place them to their credit. They honor checks or orders drawn on them by their customers when presented for payment and debit their customers accordingly. They keep current accounts or something of that nature in their books in which the credits and debits are entered. Apart from these, there are characteristics such as stability, soundness and probity that constitute the persona of a banker. Reputation may exclude a person from being a banker so as also to make him one. In India, the following definitions of banking and banking company contained in the Banking Regulation Act 1949 would assist in determining whether a person is a banker. Of the Banking Regulation Act 1949, Section 5B and C provides as follows. Banking means the accepting for the purpose of lending or investment of deposits of money from the public, repayable on demand or otherwise, and withdrawal by check, draft or otherwise. Banking company means any company which transacts the business of banking in India. Explanation: any company which is engaged in the manufacture of goods or carries on any trade and which accepts deposits of money from public merely for the purpose of financing its business, and as such a manufacturer or trader shall not be deemed to transact the business of banking within the meaning of this clause. Interpretation clause. The Act allows banking companies to transact various other kinds of business specified in Section 6 of the Act. Section 7 of the Act generally prohibits non-banking companies and cooperative societies other than cooperative banks from using as part of their name any of the term bank, banker or banking. No company or a cooperative society can carry on banking business in India unless it uses at least one of the terms as part of its name. Under the Banking Regulation Act 1949, Section 49A, no person other than a banking company, the Reserve Bank of India, the State Bank of India, or any other banking institution, firm or person notified by the central government on the recommendation of the Reserve Bank shall accept public deposits that can be withdrawn by check. This restriction does not apply to a primary credit society, certain other cooperative societies, and any government savings bank scheme such as a postal saving bank. Receiving money from customers and repaying it by honoring their checks as and when required is one of the functions which distinguishes banking business from other kinds of business. Therefore, Nattu Kottai Chettiars who carry on money lending business cannot be considered bankers. A company lacking the power to grant loans and to receive public deposits repayable in the manner indicated under of the Banking Regulation Act 1949 Section 5B cannot be considered as a banking company. Government treasury was held by a banker under Section. Next, promissory notes. A promissory note is an instrument in writing, not being a banknote or a currency note, containing an unconditional undertaking signed by the maker to pay a certain sum of money only to and to the order of a certain person or to the bearer of the instrument. Illustrations. A single A signs instruments in the following terms. I promise to pay B or order rupees 500. I acknowledge myself to be indebted to B in rupees 1000 to be paid on demand for value received. Mr. B, I owe you rupees 1000. I promise to pay B rupees 500 and all other sums which shall be due to him. I promise to pay B rupees 500, first deducting there out of my money which he owes to me. I promise to pay B rupees 500 7 days after my marriage with C. I promise to pay B rupees 500 on D's death provided D leaves me enough money to pay that sum. I promise to pay B rupees 500 and to deliver to him back my black horse on 1st January next. The instruments respectively marked A and B are promissory notes. That is, I promise to pay B an order of rupees 500. I acknowledge myself to be indebted to B rupees 1000 to be paid in demand for value received. They are promissory notes. The instruments respectively marked C, D, E, F, G, H are not promissory notes. Okay. Requisites of a promissory note. The definition of a promissory note under Section 4 is exhaustive and excludes from the category of promissory notes instruments which do not fall within its terms. No particular form of words is essential to constitute a promissory note. Any form of expression from which an undertaking to pay can be inferred is sufficient. The mere nomenclature given to the instrument does not determine the nature of instrument. The instrument has to fulfill all the requisites of a promissory note to be called so, and merely because the parties describe it as a promissory note does not make it so. The description and language of the instrument taken as a whole, the circumstances under which it came to be executed, the intention of the parties manifest from the face of the instrument, and the surrounding circumstances would have a cumulative bearing on a proper construction of the instrument as to whether it is a promissory note. A document has to be read as a whole to determine its nature. If there is an unconditional undertaking signed by the maker to pay a certain sum of money only to or to the order of a certain person or to the bearer of the instrument, it will be a promissory note. The mere inscription of words to some effect do not determine its nature. Thus, where the document is in the form of an acknowledgement coupled with a promise to pay by a particular date, it is a promissory note, though stated to be a hundi. To find out whether a particular document is a promissory note, the intention of the parties has to be looked into. With reference to the substance of the document, the surrounding circumstances in which the document has been executed and its negotiability in the proper sense, whether the document was intended to be a promissory note or was intended to be a mere acknowledgement of a debt or receipt for consideration. A single instrument may embody several purposes, and the document is said to be read as a whole to find out its dominant purpose, which is relevant for the purpose of the Act. In Kadorilal versus Sukulal, after reviewing several authorities, it was held that the whole document, its tenor, the purpose for which it was executed as described in the document itself, should be considered. For determining the nature of the documents, collateral circumstances which may be contained in evidence cannot be looked into for this purpose. The most important element for determination of the question whether the instrument is a promissory note is the intention of the parties. If the parties had no intention to execute a promissory note, then even though the instrument fulfills all the requirements of a promissory note, it may not be a promissory note. Thus, the document primarily intended to be a receipt or a bond and not intended to be negotiable in the ordinary mercantile sense does not become a promissory note within the meaning of the Act. Conversely, merely because the parties intended to execute a promissory note does not make it so if it does not fulfill all the requisites of a promissory note. The incident of negotiability is not essential to the validity of the promissory note, provided the requirements of the section are complied with. Therefore, if an instrument satisfies the requirements of the definition contained in the section, it must be held to be a promissory note, irrespective of whether it is negotiable. Negotiable instruments, including a promissory note, are meant for free circulation, and thus the most important requisite of these instruments is certainly regarding all their essential aspects, the essential characteristics of a promissory note. Statutorily recognizes the various aspects as to the certainty. A promissory note may contain a promise to pay a certain sum of money to a certain person or to his order or to the bearer in order to fall within the definition of a promissory note. It is necessary that there should be an unconditional undertaking to pay a certain sum of money to a certain person or to bearer, and the maker should sign it. Apart from fulfilling the above terms, the promise to pay must be in the substance of the instrument. There should be nothing else inconsistent with the character of the instrument, and the instrument must be intended to be a promissory note. A careful examination of the definition will show the following requisites of a promissory note. 1. A promissory note must be in writing. Every engagement connected with a promissory note must be signified by writing upon the instrument itself. The object of this requirement is to exclude an oral engagement to pay from the purview of the Act. The writing may be pencil or ink. Writing shall be construed to include printing, lithography, and other modes of representing and reproducing words in a visible form. The writing may also consist of either printed or typewritten as well as handwritten matter. There is also no requirement that the writing should be on a paper. The note may be written on cloth, linen, or any other thing that can be used for such purpose. No particular form of writing is necessary for the validity of a promissory note, provided the requirements of a section are complied with. It is not necessary to adhere to any form of words so long as the conditions of the definition are observed, in which case the language in which the instrument is written is immaterial. It is not necessary that the words promise should be used, provided the language used clearly shows an intention on the part of the maker to give an unconditional undertaking to pay the amount. An instrument, however, might satisfy the requirements of section, yet not be a promissory note. Thus, the banker's deposit note in the form received of A rupees 500 to be accounted for on demand and signed by the maker is not a promissory note. Further, the instrument must show the party's intention to make a note. The word hand note in a blank endorsement written across the stamp was held to convey an unqualified undertaking to pay, as was necessary in the case of a promissory note. The instrument may be written in any language, but when it is in Oriental language, it is a hundi and may be subject to local usage. Point number 2. A promissory note must contain an undertaking to pay. The essential element of a promissory note is an express promise to pay. A mere acknowledgement of indebtedness without an express promise to pay the debt is not a promissory note. Examples of instruments which are not promissory notes. 1. Mr. X, I owe you 100. It makes no mention of payment. Promise to pay. I have received 1000 which I borrowed of you, and I have to be accountable to you for the same with interest. Third, the amount which I have this day received from you in cash is rupees 1000. This sum I am bound to pay to you. Next, deposited with me rupees 1000 to be returned on demand. 5. I am liable to A in some thousand which is to be paid by installments for rent. 6. This receipt is hereby executed by B for 43,900 received from firm of for on behalf of A. Amount to be payable after 2 years. Interest at the rate of 540% shall be per year to be charged. Dated 1/4/47. The Privy Council held that the document was a receipt for money containing the terms on which it was to be repaid, and being primarily a receipt, even if coupled with the promise to pay, it was not a promissory note or a document which was negotiable instrument within the meaning of sections 4 and 13 of the Act. I, of my own free will and accord, approached A and borrowed from him the sum of 100 bearing interest at the rate of Anna's 8% per mensum. I have therefore executed these few presents by way of a promissory note so that it may serve as evidence and by of use when needed. Here it was held that an instrument is not a promissory note as defined under section 4 unless it contains an express undertaking to pay the amount mentioned in the instrument. An implied undertaking inferred merely from the use of the words debt or pronote are not sufficient. A piece of writing containing a signature with the words Rs 150 on the 1 Anna stamp, even if the signature be genuine, was held not a promissory note within the meaning of section 4 of the Act. A receipt containing an undertaking to repay pounds 10,000 loan in full by a stated date at an agreed interest was held not to be a promissory note by the Court of Appeal as the borrower had the option to repay earlier than the stated date. The document was held to be only a receipt setting out the terms of repayment and was not intended to be a negotiable instrument. A document that stated, "We have received a sum of 9240 from P. The above amount will be repaid on demand. We have received 9240 in cash today," which was signed by the maker and also contained an endorsement by a third party guaranteeing repayment, was held to be a promissory note and not a bond. Where a promissory to pay is absent, even the fact that the document is written on a hundi paper and attested cannot make it a promissory note. However, the mere absence of the words "I promise to pay" does not alter the character of the document, provided a promissory note fulfills the requirements of the section and there is a clear intention on the part of the parties to treat the document as a promissory note. A mere acknowledgement of the indebtedness does not constitute a promissory note. However, if in addition to an acknowledgement of indebtedness there is an express promise to pay the amount acknowledged as being due, that instrument is a promissory note. Where, however, the acknowledgement of indebtedness contained in the document is for a defined sum of money payable on demand, the document need not necessarily stipulate that the debtor promises to repay the amount. A document described as an acknowledgement was nevertheless held to be a promissory note as it satisfied the requirements of the section. An instrument containing an acknowledgement of indebtedness without an express promise to pay, though not a promissory note, is valid an agreement and may be sued upon as such. A document containing a promise to pay would not be a promissory note if it were primarily intended to be a receipt and not intended to be negotiable in the ordinary mercantile sense. The legal character of the document would depend upon the facts of the case. The stamping of a document as a receipt reflects the party's intention not to treat it as a note. The mere fact that the document recites how the consideration was fixed, that a part of it is worded like an agreement, does not deprive the document of a character as a promissory note, provided it contains words which in law can be construed as a meaning a promise to pay. Similarly, an instrument that satisfies the statutory requirements of a promissory note would not lose its character as such, merely because it states the purpose for which the maker borrowed the money. Also, a reference in the note to a sale contract which gave rise to the note would not alter its character. The following instruments were held to be promissory notes. Rupees 1000 balance due to you, I am still indebted and do promise to pay. Received from X rupees 1000, which I promise to pay on demand with interest. I do acknowledge myself to be indebted to X in rupees 1000 to be paid on demand for value received. We shall order the borrowed monies to be repaid. Whereas with regard to Glass of Hanneman Glass Works, account is due from us. We therefore acknowledge and promise to pay on demand 1781 with interest at a 2% per mensum. We have executed this promissory note for a total sum of 2,400 made up of on demand by you. We will pay the amount due on this promissory note along with compound interest at 13 annas % per month with annual interest. We have executed this promissory note. A 4 anna revenue stamp had been affixed. Document purported to be signed by the executants was held to be a promissory note. An undertaking to pay on demand necessarily implies a promise to pay. Therefore, a promissory note expressed as payable on demand is a promissory note within the meaning of the section. I have already received 15,000 from Colombo AS shop for doing business of my own. I shall pay it after 2 years on demand by you with interest at 2 annas per month per 100 to you or to your order and receive back this promissory note. A promissory note is no less a note merely because it contains a recital that the maker of the note has deposited title deeds with the payee. The expression on demand is a technical expression meaning that the amount mentioned in the institution is payable immediately. However, it does not imply that a demand has to be made before payment can be enforced. The word on demand only means that the note is payable immediately or at sight and does not in itself take the promissory note out of the purview of Section 49 of Indian Contract Act 1872. A holder who sues on demand instrument without having first demanded payment thereon may have to bear the cost of the action if the debtor shows that he was always ready and willing to pay. Further, where a note is payable with after demand or when demanded, it is not deemed to be payable till an actual demand has been made. Where a promissory note payable and demand is accompanied by a writing which postpones the time for payment to a fixed period, such a writing is valid and enforceable. The negotiable character of the promissory note is not affected, and bona fide holders without notice of the accompanying writing will be protected, even if they sue before the term mentioned in the accompanying writing expires. However, as between the parties to the note and as between the drawer and holder with notice or holders who are not holders in due course, the accompanying writing would be enforced. Where there is express promise to pay, instrument will not be any less promissory note because it contains expressions of politeness or gratitude. A promissory note payable on demand would not cease to be so merely because of an endorsement thereon by the maker and the payee that no interest would be payable if the note was paid within a month. A promissory note need not be payable on demand till it may be made payable on a fixed future date or on the expiry of a specified period. An instrument containing a mere acknowledgement of indebtedness coupled with a promise to repay within a few days was held not to be a promissory note. A promissory note does not lose its character as such merely because it contains a promise to pay at a certain place. Third point, the promise to pay should be unconditional. An unconditional undertaking to pay a certain sum of money is an indispensable statutory requisite without which no instrument can be called a promissory note within the meaning of the Act. Thus, a valid promissory note must contain an unconditional promise to pay. Certainty is the key element in negotiable instruments, and unless they are per se valid, they are not negotiable. Lord Kenyon stated thus in Carlos versus Fancourt, it would perplex the commercial transactions of mankind if paper securities of this kind were issued out into the world, encumbered with conditions and contingencies, and if persons to whom they were offered in negotiation were obliged to inquire when these uncertain events would probably be reduced to certainty. Notes that are payable on a contingency are therefore not negotiable as their actual payment is not certain. An instrument must be valid ab initio and carry its own validity on its face. Therefore, if payment is contingent upon the happening of an uncertain event, it would be invalid even if the event occurs before the expiry of the period fixed for the performance of the obligation. The following are examples of instruments held as not promissory notes. I promise to pay X 5,000 in installment with a proviso that no payment shall be made after my death. A letter requesting a loan stating that the amount lent would be repaid is not a promissory note because the repayment is dependent on the advance being made. Thus, a document stating ₹100 already received, a sum of 500 is also required. Please send it per bearer. The amount will be returned with interest at 6% without delay is not a promissory note. I promise to pay X ₹500 on A's death provided he leaves me sufficient money to pay the said sum is conditional and void as a promissory note. An instrument containing a promise to pay a certain sum to X a certain time after his marriage is not a good promissory note as X may not marry at all. I promise to pay AB 500 out of money due to me from XY as soon as XY pays. It is a conditional because XY may never pay the money. I promise to pay on demand at my convenience. The words at my convenience import a condition, and the writing is not a promissory note. An instrument containing a promise to pay settlement of account when the litigation comes to an end. Banking. Foreign instrument, ChatGPT. A foreign instrument is a negotiable instrument such as a bill of exchange, promissory note, or a check that is drawn and made payable outside of the country in which it is presented for payment or negotiation. For example, a bill of exchange that is drawn in the United States and payable in India would be considered a foreign instrument in India. Foreign instruments are subject to different laws and regulations in different countries, and they may require additional documentation and verification before they can be negotiated or paid. The process of negotiating and paying a foreign instrument may involve the use of international banks and conversion of currency. The negotiation or payment of a foreign instrument may also be subject to fees and charges, such as exchange rates and commission charges, which can affect the amount that the holder of the instrument ultimately receives. It is important for parties involved in the negotiation or payment of a foreign instrument to be familiar with the laws and regulations of the country in which the instrument is being presented for payment and negotiation, and to seek advice and assistance from qualified professionals such as international bankers, lawyers, and accountants. Banking Regulation Act provisions. The Banking Regulation Act 1949 is an important legislation that regulates the banking industry in India. Some of the key provisions of the Act are as follows. 1. Licensing of banks. The Act provides for licensing of banks and sets out the eligibility criteria for obtaining a banking license. 2. Regulation of shareholding. The Act regulates the shareholding of banks and sets out the maximum permissible limit of shareholding that a single entity can hold in a bank. Management and control of banks. The Act lays down provisions relating to the management and control of banks, including appointment and removal of directors, responsibilities and duties of the board of directors, and powers of Reserve Bank of India to regulate and supervise banks. Regulation of banking operations. The Act regulates the operations of banks, including acceptance of deposits, granting of loans and advances, the issuance of bank guarantees, and the establishment of branches and offices. Maintenance of reserve requirement. The Act requires banks to maintain CRR and SLR with RBI. Regulation of mergers and acquisition. The Act regulates the merger and acquisition of banks and sets out the procedure for such transaction. Prohibition of insider trading. The Act prohibits insider trading in the shares of banks and sets out penalties for violation. Protection of depositors. The Act provides for the protection of depositors' interest, including insurance of deposits and establishment of deposit insurance scheme. Enforcement of penalties. The Act sets out penalties for violation of its provisions and establishment a mechanism for the enforcement of such penalties. Overall, the Banking Regulation Act 1949 plays a crucial role in regulating and supervising the banking industry in India, ensuring the stability and integrity of the financial system and protecting the interest of depositors and other stakeholders. Procedure of dishonor of check and legal provisions. Dishonor of a check occurs when a bank refuses to make payment of the check presented by the payee due to various reasons such as insufficient funds, account being closed, the signature mismatch. The legal provisions related to dishonor of check are governed by the Negotiable Instrument Act 1881 and the Code of Criminal Procedure 1973. The procedure for dishonor of a check is as follows. Issuing a legal notice. The first step is to issue a legal notice to the person who issued the check stating that the check has been dishonored and demanding payment within a specified period, usually 15 days. Filing a complaint. Next, if the person who issued the check does not make payment within the specified period, the payee can file a complaint before magistrate. The complaint must be filed within 30 days from the date of receipt of the legal notice. Recording of evidence. The magistrate will issue summons to the person who issued the check and the complainant and witnesses will have to record their evidence before the court. Decision by the magistrate. After hearing the parties and examining the evidence, the magistrate may either dismiss the complaint or issue an order for payment of the check amount along with interest and cost. Appeal. If the complainant is not satisfied with the decision of the magistrate, they can file an appeal before the higher court within 30 days. Execution. Once the order for payment is passed by the court, if the check issuer still fails to make the payment, the complainant can initiate execution proceedings such as attachment of property or to recover the amount. It is important to note that dishonor of a check is a criminal offence and the punishment for the same may include imprisonment and or fine. Evidence presumptions of a negotiable instrument. Under Negotiable Instrument Act 1881, certain evidential presumptions are attached to negotiable instrument. These presumptions make it easier for the holder of a negotiable instrument to prove their case in case of a dispute. The following are the evidence presumptions of negotiable instrument. Presumption of consideration. The law presumes that a negotiable instrument was made for a valuable consideration unless contrary is proved. Presumption of date. The date mentioned on the negotiable instrument is presumed to be the date of its execution unless the contrary is proved. Presumption of time of acceptance. If the instrument is payable after a certain period of time, the date of acceptance is presumed to be the date on which it was delivered for acceptance unless contrary is proved. Presumption of the order of endorsement. The order of endorsement on a negotiable instrument is presumed to be the order in which the endorsements are made unless the contrary is proved. Presumption of dishonor. It is if a negotiable instrument is dishonored, the law presumes it was dishonored for insufficiency of funds unless the contrary is proved. Presumption of notice of dishonor. If a notice of dishonor has been given, the law presumes that it was given within a reasonable time unless contrary is proved. It is important to note that these evidential presumptions are rebuttable, which means that they can be challenged by producing evidence to the contrary. However, until such evidence is produced, the court will presume that these presumptions were true. DRT, Debt Recovery Tribunals, are special courts in India that were established under Recovery of Debt Due to Banks and Financial Institutions Act 1993 to help banks and financial institutions recover their non-performing assets from defaulting borrowers. The DRTs have the following jurisdiction and powers. Jurisdiction. DRTs have jurisdiction over cases where the debt claimed by the bank or financial institution is more than 20 lakhs. They also have jurisdiction to entertain appeals against the orders of the secured creditors passed under SARFAESI Act. Recovery of debt. DRTs have the power to recover debt due to banks and financial institutions by issuing recovery certificate against defaulting borrower. These certificates can be executed like a decree of a civil court. Enforcement of security interest. DRTs have the power to enforce security interest in the properties of the defaulting borrower, which are pledged as collateral security for the loan. Attachment and sale of property. DRTs have the power to attach and sell the properties of the defaulting borrowers to recover the outstanding dues of the banks and financial institutions. Appointment of receivers. DRTs can appoint a receiver to take possession of the assets and manage the affairs of the defaulting borrower during the pendency of the proceedings. Summoning of witnesses and production of documents. DRTs have the power to summon witnesses and call for the production of documents to assist them in proceedings. Contempt of court. DRTs have the power to punish for contempt of court if any person disobeys the orders of the tribunal or obstructs the proceedings. Overall, DRTs are a powerful mechanism for banks and financial institutions to recover their NPA from defaulting borrowers. Tribunals are empowered with the quasi-judicial powers, which mean their orders have the force of law and can be enforced like a decree of a civil court. Bankers Bank. The Bankers Bank, also known as a central bank or a reserve bank, is a financial institution that provides banking services to other banks and financial institutions. Its main objective is to maintain monetary stability and promote economic growth by regulating the supply of money and credit in the economy. Functions of a banker's bank include: 1. Monetary policy. The central bank formulates and implements monetary policy, which includes controlling the money supply, interest rates, and credit availability in the economy. Banker to the government. Central bank acts as a banker to the government by managing the government's accounts, issuing government securities, and managing public debt. Lender of last resort. The central bank provides liquidity support to banks and financial institutions in times of financial distress. It acts as a lender of last resort by providing loans and advances to banks against eligible securities. Regulation of banks and financial institutions. The central bank regulates and supervises banks and financial institutions to ensure that they operate in a safe and sound manner and comply with the regulatory framework. Currency management. The central bank manages the supply of currency in the economy, issues and withdraws currency notes and coins, and maintains the stability of currency. Examples of bankers' bank around the world include Federal Reserve in the United States, European Central Bank in European Union, Reserve Bank of India in India. Banker and a trustee role. A banker and a trustee are two distinct roles that can be performed by the same financial institution or individual, but they involve different responsibilities and duties. A banker is a financial institution that provides a range of financial services to its customer, including accepting deposit, making loan, providing other financial products and services. As a banker, the financial institution has a duty to act in the best interest of its customer and to maintain the safety and soundness of operations. Bank is also responsible for maintaining the confidentiality and privacy of its customers to financial information. On the other hand, a trustee is an individual or institution that holds and manages assets on behalf of another person or organization. Trustee has a fiduciary duty to act in the best interest of the beneficiary and to manage the assets in accordance with the terms of trust agreement. Trustee is responsible for investing the trust assets, paying expenses and taxes, and distributing the trust income and principal to the beneficiaries as specified in the trust agreement. While a bank can act as a trustee, the roles are separate and distinct. As a trustee, the bank is responsible for managing the trust assets in accordance with the terms of the trust agreement and for fulfilling its fiduciary duty to the beneficiaries. As a banker, the financial institution is responsible for providing banking services to its customers and managing its operations in a safe and sound manner. It is important for the bank to maintain a clear distinction between these roles to avoid conflict of interest, to ensure that its actions are in the best interest of its customers and the beneficiaries of the trust. Demand draft. A demand draft is a type of negotiable instrument used for making payments. It is a prepaid instrument, which means that the amount paid for the draft is already deposited in advance with the issuing bank. A demand draft is also known as a bank draft. When a demand draft is issued, the issuing bank guarantees the payment to the recipient or the beneficiary of the draft. The funds are transferred from the account of the person of the organization requesting the draft to the bank's own account, and the bank issues the draft to the recipient. The demand draft is considered to be a secure and reliable way to transfer funds because the issuing bank has already received the funds in advance. Demand drafts are commonly used for making payment for various purposes such as paying bill, making purchases, sending money to another person or organization. They are often used for making large payments or payments across different regions or countries. Demand drafts are considered to be a more secure method of payment compared to personal checks because they are guaranteed by the issuing bank. To obtain a demand draft, a person or organization needs to visit a bank and provide the necessary information such as the amount to be paid, the name of the recipient or beneficiary, and the recipient's bank account details. The issuing bank will then deduct the amount of the draft from the person's account and issue the draft to the recipient. The recipient can then deposit the draft in their bank account and receive the fund. What is the difference between cancelling contract and rescission of a contract? Difference between cancelling a contract and rescission of a contract. Cancelling of a contract and rescission of a contract are two different legal concepts that refer to the termination of a contract. Cancellation of a contract typically occurs when one party exercises a contractual right to cancel the agreement. For example, a buyer may have a right to cancel a purchase contract within a certain time frame, or a service provider may have the right to cancel a service contract if the customer fails to pay. In such cases, the contract is terminated by mutual agreement of the parties or by the exercise of a specific contractual right. The parties are released from their obligations under contract. On the other hand, rescission of a contract refers to the cancellation of a contract due to breach of contract or some other legal defect in the formation of the agreement. In such cases, the contract is considered to have been void from the beginning, and the parties are released from their obligations under agreement. In other words, the cancellation of a contract occurs when both parties agree to terminate the contract, while the rescission of a contract occurs when one party seeks to cancel the contract due to a total legal defect or breach of contract. Case laws in NI Act. 10 major case laws in check dishonored case. Number 1. Meter and Instruments Private Limited versus Kanchan Mehta. Supreme Court laid down and reiterated the principles and guidelines that are usually followed in cases pertaining to Section 138 of Negotiable Instrument Act, 1881. The object of introducing Section 138 and other such provisions is to enhance the acceptability of checks in settlement of liabilities. The offence punishable under Section 138 of the Act of 1881 is primarily related to a civil wrong, and the Amendment Negotiable Instrument Amendment Miscellaneous Provision Act 2002 specifically made it compoundable. Case number 2. Bhaskaran Nair vs. Abdul Karim 2006 4 KLT 48. The Kerala High Court held that the defense that a signed blank check was handed over by an account holder is intrinsically suspicious one and must be appreciated with great care and caution. No account holder is expected to deal with a check in such a casual, careless, irresponsible and indifferent manner, and such a defense is impossible. Mohiddin vs. Johnny 2006 3 KLT SN 62. The Kerala High Court held that by issuing a signed blank check, the drawer conveys an implied authority to fill up the check and present the same for encashment by the other party. Case number 4. Lillikutti vs. Lawrence 2003 3 KLT 721. The Kerala High Court held that the mere fact that the payee's name and amount shown are not in the handwriting of the drawer does not invalidate the check. No law provides that the body of the check has to be written by the drawer only in his own handwriting. What is material is the signature of the drawer only and not the body of the instrument. Case number 5. ICDS Limited vs. Bina Shabir 2002 3 KLT 218 SC. The Apex Court held that a check given as security for the liability of an accused or for the liability of any person would also fall under the mischief of offence punishable under Section 138 of NI Act. Case number 6. Kaushalya Devi Masand vs. Rup Kishore, AIR 2011 SC 2566. Supreme Court held that the offence under Section 138 of the NI Act is almost in the nature of a civil wrong, which has been given criminal overtones, and the imposition of fine payable as compensation is sufficient to meet the ends of justice, that it is compoundable. Arrest and jail is not compulsory. Question number 7. Messrs. Mandvi Cooperative Bank Limited vs. Nimesh B. Thakur. On 11 January 2010, Apex Court took notice of the fact that cases under 138 of the Act have been coming in such great multitude that even the introduction of such radical measures to make the trial procedure simplified and speedy has been often little help, and cases of dishonored checks continue to pile up, giving rise to an unbearable burden on the criminal justice system. Case number 8. Pawan Kumar Rali vs. Maninder Singh Narula 2014 15 SCC 245. The High Court was not right in quashing the complaint merely on the ground that the complaint is barred by limitation, that too a plea which was taken for the first time before the High Court. On the other hand, the High Court ought to have remanded the matter to the trial court for deciding the issue of limitation. High Court has no power to decide what trial court can decide, especially limitation. Question number 9. Vijayan vs. Baby 2011 4 KLT 355. The Supreme Court held that the direction to pay the compensation by way of restitution in regard to the loss on account of the dishonor of a check should be practical and realistic. So, in a prosecution under Section 138 of NI Act, the compensatory aspect of remedy should be given much priority over the punitive aspect. Case number 10. Srimati P. Vijayalakshmi vs. Srimati S.P. Shravana on 27th October 2017. As regards the remedy of appeal available to the complainant against the orders of acquittal in cases pertaining to any other offence, it may be noted that the right of appeal given to victims under proviso of Section 372 of the Code is a general remedy provided to all such victims.